The banks have had a stellar time funding it all, but the regulator isn't so keen on rampant investor lending or the levels of cash banks are holding in case things go pear-shaped. APRA's boss hinted this week of a crackdown sooner rather than later. And that saw $20 billion wiped off the bank's share prices over the last couple of days. Investor loans have been the hooch in the bank's punch bowl, and APRA has been trying to tone down the party since back in December by introducing a 10% cap on growth in investor lending. But all of the major banks have either exceeded that cap or flirted with it every month since. So, are the bank profits in any danger? Next week, 3 of the big 4 will open their books for inspection, and despite all the turmoil, profits are expected to be huge. Andrew Robertson reports.
It's the sector that seems to walk on water. Bank profits only appear to head one way, and that's up, despite constant predictions over the last few years of tougher times ahead.
The profits keep on going up because asset quality or bad debts remain low and have been getting lower. Plus, there has been some credit growth.
The stock market's financial index, which is dominated by the big banks, is up 9% this year, over 1% more than the market as a whole. But take a second look. In the last 6 weeks, the financial index has fallen nearly 5%. So are the tough times finally arriving?
We are seeing some interesting dynamics in terms of margins and also costs. And I think it's going to be harder for the banks to be able to face those headwinds and continue to provide the same level of returns to shareholders as they have been.
Back in February, Commonwealth Bank unveiled an 8% rise in first-half earnings to $4.5 billion. The other 3 members of the Big 4 report their first-half profits next week, starting with Westpac on Monday and finishing with NAB on Thursday. In the middle of the week will be Commonwealth's third-quarter update. BBY's Brett de Mesurier thinks results will be mixed, but thinks NAB could deliver a pleasant surprise if it's fixed some of the problems in its troubled UK division.
If they don't have the same level of provisions that they had in the 2014 financial year, then they will show a large increase in profit.
Brett de Mesurier thinks ANZ will be weighed down by poorer than expected returns from its Asian strategy, while Westpac and CBA will benefit from their higher exposure to the housing market. Next week's 3 half-year results are expected to top $11 billion, helped by a continued lowering of bad debt provisions made in the wake of the GFC. But what's occupying the minds of bank investors are things lying further down the track. Front and centre is the global push for banks to hold more capital as a buffer against the bad times. It's something the government's financial system inquiry supports, with the chairman of the prudential regulator APRA putting the jitters through bank shares this week when he publicly agreed.
We don't need to wait for every I to be dotted and every T to be crossed in the international work before we turn our minds to an appropriate response to the FSI's recommendations. Some, such as Recommendation 2 on mortgage risk weights and Recommendation 4 on international capital comparisons, seem able to be dealt with sooner rather than later.
Which could see the banks having to put $20 to $30 billion aside. But Martin North says that's not huge for banks as big as the Big 4.
The banks will be able to cope with the higher capital ratios, and anyway, they can pass a lot of those higher costs onto the consumers, either on lower deposit margins or higher loan margins.
With interest rates so low, bank shares with their high dividend ratios have become a favoured target for those searching for yield. The question many people are asking is, how long can those high payout ratios continue as the economy slows?
I think dividends will continue to increase on a consistent basis, probably through to 2020. That's my best guess. I don't think that will be a problem until there's a spike in the bad debt charge, and I don't think there will be a spike in the bad debt charge until we've had a period of heightened credit growth.
With their huge exposure to a housing market that in places like Sydney is very overheated, Martin North thinks rising unemployment could become a major issue for the banks. But probably the biggest challenge is what's happening in the digital space, with its potential for great change and great disruption, as other established industries have found out the hard way.
I guess when you're talking about a topic like this, the number one question is, how's it all going to play out? And I can put an answer to that question pretty quickly, which is I don't know.
What we do know is that the consensus seems to be that the banks are well placed to weather the challenges ahead, even if the ride at times becomes a rocky one.
Andrew Robertson with that report.